Before we deconstruct the exact mathematical blueprint to extract your wealth from the Middle East, I have 3 critical questions for you to answer in the comments below. Number 1. Are you planning to wire your entire UAE life saving back to your home country using a standard bank transfer without consulting a cross-border tax architect? Number 2. Do you realize that transferring your wealth at the wrong time of the fiscal year could instantly trigger a massive, inescapable 20% tax liability the second your flight lands? Number 3. Have you factored in the compounding destruction of global inflation, or are you just blindly hoping your purchasing power survives a currency exchange? Let me know your answers. If you're new to the channel, here is my intro. I'm Dr. HR and I approach the global labor and capital market not with emotional comforting advice, but as a structural algorithmic system. I hold a PhD in Human Resources, a master's from prestigious Tata Institute of Social Sciences TISS in Mumbai, and a bachelor's in Computer Engineering. Operating on the ground here in Dubai since 2010, consulting for Tier 1 corporate entities, sovereign wealth funds and apex tech founders across the Middle East and the Indian subcontinent, I have monitored exactly how the global wealth is accumulated, leveraged and ultimately preserved. The global banking grid does not reward you for working hard. It rewards you for structural precision. You have spent years building your wealth in Emirates, but leaving now could cost you an absolute fortune if you aren't meticulously careful. Between skyrocketing global inflation and aggressive new cross-border tax traps implemented in 2026, your hard-earned savings are under immediate existential threat. Do not let the exit gate become a financial drain. Here is exactly how you protect every single penny during your relocation. Most expat thinks moving their money home is a simple bank transfer, but that amateur mistake is currently destroying portfolios in this high inflationary climate. To stay ahead in 2026, you need to completely stop following traditional banking advice and start utilizing the highly shielded, tax-efficient corridors that the ultra-wealthy use to bypass high-fee and confiscatory tax rates. We are breaking down the exact architectural blueprint for a tax-free, zero-friction exit. If your exit strategy actually inflation-proof, or are you about to lose 20% of your purchasing power the moment you touch ground? With global market in absolute flux, expat leaving the UAE face a unique set of automated tax hurdles that literally did not exist 2 years ago. I'm showing you the legal loophole to transfer your wealth without triggering massive, life-altering tax liability. Before I completely dismantle the illusion of standard SWIFT transfer, expose the exact mechanics of a global tax dragnet, and give you the precise architectural blueprint to shield your capital during extraction, hit the subscribe button and press the notification bell. I post daily videos showing you exactly how to navigate the global labor and capital market using cold, hard engineering logic. You do not want to miss this execution protocol. Stop treating your capital like an afterthought. Grab a notebook, it is time to engineer your extraction. Phase 1, the terminal transfer trap, the fear of loss. We must first diagnose the exact debilitating vulnerability that destroys the wealth of 90% of departing expatriates. You have lived in Dubai for 10 years, you have accumulated a massive tax-free capital base in AED or USD. The corporate tenure is concluding and you are preparing to relocate back to London, Mumbai, Sydney or Toronto. The amateur operator packs their bag, logs into their Emirates MBD or banking app, hit international transfer and wire 2 million dirhams to their home country account. They believe they have successfully extracted their wealth. They have actually just walked blindly into a terminal transfer trap. When a massive sum of capital suddenly hits a centralized banking node in a high tax jurisdiction, it triggers the immediate algorithmic flags. The local tax authority, whether it is HMRC in the UK, the IRS or the Income Tax Department in India, instantly initiates an audit protocol. Because you wired the money after you established a physical residency in that country, or because you failed to legally wrap the asset before the transfer, the capital is now subjected to the brutal, unforgiving physics of the local tax code. You are instantly exposed to the capital gains tax, global income declaration, and remittance taxes. Furthermore, you're transferring raw fiat currency in a macro environment devastated by inflation. If you transfer your wealth from a hard-pegged currency like UAE dirham into a volatile flat currency right as inflation spikes, the purchasing power of your life savings evaporate in real time. You have spent a decade generating a 0% tax yield only to surrender 20 to 40% of it at an absolute final hurdle because you relied on a retail banking interface instead of a structural tax architect. Do not let the exit gate become a financial drain. The global tax system is a complex predatory algorithm. To survive the extraction, you must rewrite the code of your capital. Phase 2, the tax domicile matrix, the high-stakes question. To bypass the trap, we must understand the precise mechanism that triggers the tax liability. We must decode the tax domicile matrix. The fundamental error most expat makes is confusing physical travel with legal residency. You believe that you become a taxpayer in your home country on the day you unpack your unboxes. The algorithmic reality of a global tax law is vastly different. Tax residency is triggered by a highly specific, mathematically rigid threshold. Let us examine the UK's statutory residency test, SRT, or India resident but not ordinary resident, RNOR status. These are legal tripwire. If you are relocating to the UK, the HMRC algorithm calculates your tax residency based on the number of days spent in the country combined with your ties, family, accommodation, previous visit. If you accidentally trigger the tax residency on April 15th, but you sell your Dubai real estate and transfer the cash on April 20th, you have executed a catastrophic sequencing error. Because you were a UK tax resident at the exact moment the asset was liquidated, the capital gains were realized, the UK government has a legal authority to tax your Dubai profit. The high-stakes question is this: are you timing your exit or are you just booking a flight? In India, returning NRIs, the non-resident Indians have a massive legally engineered shield called RNOR status. This status allows you to keep your foreign income and foreign-generated capital gains entirely tax-free for up to 3 years after you return. But if you fail to structure your Dubai bank account correctly, or if you remit the funds into a wrong type of resident account, you break the shield. You trigger the liability. With global markets in flux and the implementation of OECD's global minimum tax frameworks, governments are aggressively hunting for capital inflow. The tax hurdles are higher than they were 2 years ago. The Common Reporting Standard, the CRS, means your home country already knows exactly how much money you have in the UAE. You cannot hide it. You must legally structure the timeline of your arrival so that your capital enters a jurisdiction before the tax algorithm classifies you as a biological resident. Phase 3, the Fiat furnace, the inflationary devaluation. We must now address the silent, invisible force that will destroy your wealth even if you perfectly navigate the tax laws. We must map the Fiat furnace. In 2026, the global inflation is not a temporary anomaly, it is a structural feature of a highly indebted national economies. When you live in Dubai, your wealth is held in UAE dirham, which is immutable pegged to the US dollar. You are insulated by a relative hard fiat architecture. When you relocate to a jurisdiction with a high volatility or inflating currency, you face a brutal macroeconomic shock. The amateurs simply convert AED to GBP, Euro or INR and leave it at a standard checking account to pay for their new life. This is an algorithmic suicide. If inflation in your target country is running at 7% and your capital is sitting in a retail bank account yielding 3%, you are bleeding 4% of your net worth every single year. You're losing 20% of your purchasing power over a 5-year horizon. You're throwing your tax-free Dubai saving directly into a furnace. To execute an inflation-proof exit, you must decouple your wealth from raw fiat currency before you migrate. Apex operators do not transfer cash, they transfer assets. They execute the extraction by moving their capital into high-yield, inflation-resistant vehicles while still operating under a 0% tax umbrella of the UAE. They buy sovereign equities, global index funds, or decentralized digital assets prior to boarding the plane. When they land in their new jurisdiction, their wealth is not sitting in a depreciating fiat account waiting to be spent. It is locked inside an appreciating structural asset. They only liquidate the exact fractional amount of fiat required for monthly operational burn rate. If your exit strategy actually inflation-proof, If you are moving raw cash across border, the answer is mathematically no. Phase 4, the Contrarian Strategy, Offshore Wrapper and Legal Corridor. We have diagnosed the transfer trap, mapped the domicile timeline, and analyzed the inflation furnace. Now we must execute the architectural solution. How do you actually move millions of dirhams without triggering the tax net? You must deploy the Contrarian Strategy. You must utilize the tax-efficient corridors that the ultra-wealthy use to bypass the high fee. Stop following traditional retail banking advice. The retail banks is designed to extract fees from you on currency conversion and then flag you to the regulatory authority. You must build a sovereign wrapper. 1. The offshore investment bond. Instead of liquidating your UAE asset and transferring cash, Apex operator place their capital into an offshore investment bond based in a secure, tax-neutral jurisdiction such as the Isle of Man or Puerto Rico, while they are still a UAE resident. This is a massive legal loophole. Because the wrapper is established while you are an expat, the asset compounds entirely free of capital gains tax. When you return to your highly taxed home country, the capital is shielded. You can legally extract up to 5% of the original principal every single year, completely tax deferred. You have created an autonomous tax-free pension that bypasses your home country's immediate tax matrix. 2. The trust architecture. If your capital base is highly significant, you do not transfer it to your personal name. You engineer a legal separation between yourself and your money. You establish an excluded property trust. You place your global asset into the trust while you are physically and legally a resident of the UAE. When you move back to the UK, Europe, or Australia, you're not the legal owner of those assets. The trust is therefore the brutal inheritance taxes, wealth taxes, and the capital gain taxes of your home country cannot mathematically touch the core capital. You have built an impenetrable legal fortress around your Dubai wealth. 3. The asset step-up protocol. If you own physical real estate or stock portfolio in the UAE, you must execute the step-up before you leave. If you bought an Emaar villa for AED 3 million and it is now AED 6 million, you have an AED 3 million gain. If you move back to a high-tax country and then sell the villa, your home country will demand a massive capital gain tax on that 3 million dirham profit. The contrarian strategy is to sell the asset before you trigger tax residency in your new country. You realize a gain while you are still legally a UAE resident paying a 0% tax. You then immediately repurchase the equivalent asset. You have stepped up your cost basis. When you land in your new country, your taxable gain on paper is 0. You must stop acting like a passenger and start acting like a financial architect. Phase 5, the sovereign extraction protocol execution blueprint. The final phase is the exact chronological execution of your departure. If you sequence this incorrectly, the wrapper and the trust will fail. If you must strictly adhere to the sovereign extraction protocol, T-12 month, the algorithmic audit. Do not wait until your visa is cancelled. Exactly 1 year before your planned exit, you map your entire global asset base. You calculate the exact day you will trigger the statutory residence in your target country. You initiate the establishment of your offshore bond or trust architectures. You engage a cross-border tax architect, not a standard accountant. The T-6 months, the liquidation and the step-up. You will become liquidating highly illiquid physical asset in the UAE. You execute the asset step-up protocol on your stock portfolio, realizing all historical gains under the 0% UAE tax umbrella. You transfer the liquid capital out of the retail UAE banks and into your established offshore wrapper. T-3 months, the currency hedge. You do not leave your extraction to the mercy of a spot market exchange rate. You deploy forward contract or multi-currency corporate account to lock in the exact exchange rate for your required living capital. You shield your operational runway from macroeconomic fiat volatility. T-1 month, the severance extraction. When your final end-of-service gratuity EUSB hits your UAE account, you do not let it sit. UAE banks have automated algorithm that will freeze your account the moment your final salary is marked as end of service. If you have any outstanding credit card or auto loans, you must have 0 physical debt in the UAE before this hits. You immediately route this final liquidity into your offshore matrix, the clean severance. You cancel your Emirates ID, you close your retail bank account, you board the flight. When you land in your highly taxed home jurisdiction, the local tax authority algorithm scans your profile. They look for massive cash transfer. They look for sudden realized capital gains. They find absolutely nothing. Your wealth is legally wrapped into offshore bonds, protected by excluded property trust and shielded by step-up basis. Your operational capital is hedged against inflation, sitting in appreciating global asset. You have successfully executed the sovereign extraction. You built your wealth in the desert and you protected every single penny of it from global tax dragnet. Look closely at your current exit plan. Are you just packing boxes and planning a swift transfer? Or have you built a mathematical fortress around your life saving? The 2026 global economy is desperate for capital. The tax authorities are ruthlessly efficient. If you leave your home wealth exposed in the open, they will algorithmically confiscate it. Stop relying on amateur banking advice. Master the domicile timeline. Build the offshore wrapper. Execute the step-up protocol and ensure that the wealth you built in the Emirates remain absolutely permanently yours. Process the data, execute the strategy, and I'll see you at the top.